We are witnessing a profound structural shift in global finance, a shift evidenced most clearly by the parabolic move in silver, which recently touched an unprecedented high, exceeding $88 an ounce. Ignore the mainstream narrative. This is not primarily about solar panels, nor is it about AI data centers. The marginal industrial demand is a catalyst, but not the core driver. What we are observing is the market pricing in an extreme fiscal shock to the U.S. Treasury, an event that fundamentally undermines confidence in the dollar's immediate stability. This shock centers around a looming Supreme Court decision that could force the government to issue an unexpected, massive obligation. If this ruling mandates the refunding of unconstitutional tariffs dating back several years, we're looking at a sudden, unfunded liability north of $200 billion hitting the Treasury balance sheet. Such an outlay, in our current environment of trillion-dollar deficits and soaring debt servicing costs, cannot be absorbed without systemic consequence. The choices available to the Treasury are stark and equally destructive to the purchasing power of the fiat currency. The core of the argument is simple. When the sovereign borrower faces a sudden, mandated debt outside of planned issuance schedules, the market panics. Silver, alongside gold, is the ultimate flight mechanism away from counterparty risk and fiat exposure. Therefore, the run we see is a prophylactic move by smart money anticipating sovereign distress, not merely speculating on factory production. The 88 price is fundamentally a reflection of dissolving trust in the government, its ability to manage its balance sheet without resorting to inflation or devaluation. This leads us to the critical nexus, the legal vulnerability itself. The challenge relates to specific trade impositions that were enacted without proper constitutional procedure. If the Supreme Court confirms that these actions were executive overreach, the Treasury must return the capital collected retroactively. Consider the scale, $200 billion. Now, this isn't budget rounding error. This is nearly 4 months of interest payments on the national debt. If they borrow this $200 billion, they flood the market with paper, increasing supply precisely when demand for secure debt is already faltering. If they attempt to inflate the obligation away, the more likely outcome, the effect is instant currency erosion, making physical assets like silver mandatory holdings. The market understands this calculus. It is discounting the probability of a systemic Treasury headache right now. The recent spike is merely the early stages of institutional hedging against this specific, foreseeable fiscal threat. The implications extend beyond just metal prices. This ruling could set a precedent regarding the executive branch's power to unilaterally impose taxes or fees. The lack of fiscal restraint shown by both political parties has positioned us precisely where a single adverse legal ruling can destabilize the world's reserve currency. This is a direct, quantifiable threat that translates complex legal maneuvers into immediate market volatility. We are operating in an environment of unprecedented leverage, where small events have disproportionately large outcomes. The silver surge is the alarm bell warning us that the system is leveraged to the hilt, and any unexpected cost, like a $200 billion refund, is potentially catastrophic. The resulting panic is exactly why portfolio protection, using physical assets, is paramount. Moving now to the empirical evidence supporting this capital flight, the glaring price gap between COMEX and the physical market. Specifically, we must examine the massive, sustained arbitrage spread between the New York and Shanghai exchanges. In a truly efficient, integrated global market, such a spread should be closed instantaneously by high-frequency traders and arbitrage funds. The fact that Shanghai physical silver is commanding a substantial multi-dollar premium over the New York paper price is undeniable proof of market fracture. This isn't inefficiency. It is a liquidity trap driven by fundamental fear and the inability to source large quantities of physical metal quickly. The Eastern Hemisphere, particularly China, is prioritizing tangible settlement, essentially treating the U.S. paper price as unreliable for hedging purposes. What does this tell us? Capital is fleeing paper derivatives and demanding delivery, creating a chasm in pricing that reflects divergent confidence levels. The New York price is based on the confidence that the underlying physical metal is readily available and deliverable. That confidence is evaporating. In Shanghai, the price is dictated by the immediate, urgent need to secure hard assets free from the jurisdiction of Western fiscal risks. This arbitrage gap serves as the most accurate real-time barometer of smart money's true perception of dollar stability. They are willing to pay a massive premium to bypass the Western financial plumbing and hold title to physical silver now. The gap is sustained because the risk of the $200 billion fiscal shoe dropping is considered more significant than the cost of the premium. This leads directly to the actionable indicators we must monitor to predict the timing of the systemic fracture. There are two primary signals signaling acute stress: bond yields and exchange margin hikes. First, the bond market, specifically the 2-year and 10-year Treasury yield curve. Persistent deep inversion signals a lack of confidence in long-term economic growth and a scramble for short-term safety. But it also measures future debt servicing distress. The moment that yield curve begins to disinvert rapidly, not because of monetary policy success, but because of a flight out of Treasury debt, that is the red line. Rapid disinversion driven by selling long-dated debt means the market is anticipating massive long-term inflation or outright default risk. This panic will coincide almost perfectly with the realization that the $200 billion refund obligation must be monetized. Second, exchange margin hikes on silver and gold futures contracts, primarily through the CME group. When markets become volatile, the exchange increases margins to protect the clearinghouse from systemic counterparty failure. Aggressive, frequent margin hikes on precious metals futures, especially outside of typical trading hours, are a screaming signal of imminent market collapse. The exchanges are essentially saying, we believe the price volatility is about to exceed the capital held by our participants, potentially leading to failure to deliver. A massive hike is a desperate attempt to reduce open interest and risk exposure before the next parabolic move, likely driven by the fiscal news. Monitor these two indicators religiously: the panic disinversion of the yield curve and emergency margin requirements. These are the final warnings before the systemic stress breaks through the surface, validating the current $88 silver price action. The market is positioning itself for a period of extreme economic nationalism and the fracturing of global liquidity. The underlying problem is that governments globally, but especially in the West, have exhausted their credibility through perpetual deficits. The silver surge isn't speculation, it's insurance against the monetization of unsustainable debt, specifically the $200 billion sword of Damocles. In a world where confidence is the ultimate currency, the $88 silver print is proof that confidence is fundamentally eroding. We must conclude with actionable protective measures for your portfolio. The highest priority now must be portfolio resilience, favoring tangible, non-counterparty assets over paper promises. The shift away from centralized custodial holdings is non-negotiable in this environment. Holding physical silver and gold, stored securely outside the banking system, is the primary hedge against sovereign risk. The premium you pay for physical delivery, as reflected by the Shanghai gap, is the insurance cost against fiat failure. Do not confuse paper futures contracts, which are subject to margin hikes and counterparty failure, with actual ownership. The current environment demands liquidity in the form of tangible wealth that cannot be inflated or regulated away by administrative decree. The $200 billion tariff refund threat is a microcosm of the larger global sovereign debt crisis. Every nation is facing the same structural insolvency. The U.S. just happens to have a very specific, near-term legal trigger. For those who hold equity, favor companies with strong balance sheets, high operating margins, and tangible assets, especially resources. Avoid highly leveraged institutions and any financial vehicles dependent on continued quantitative easing or artificially low interest rates. We must recognize that the Federal Reserve and the Treasury are now operating primarily in crisis management mode. Their primary goal is stability at all costs, even if that cost is the long-term integrity of the dollar. The silver market, trading at $88 and beyond, is simply anticipating the inevitable decision to print money to solve a fundamental fiscal error. This is a flight to quality, driven by necessity, not mere speculation. The lesson is clear. Your wealth preservation strategy must assume the continued erosion of fiat currency value. The moment the Supreme Court ruling lands, the fiscal shock will transition from a market expectation to a guaranteed liability. The time to secure your position is now, before the panic fully translates from the metals market into the broader equities and fixed income spheres. Stay vigilant, monitor bond yields, watch for margin hikes, and prioritize physical holdings above all else. This is the true story behind silver's historic surge, a story of structural vulnerability meeting fiscal reality. The narrative that green energy industrial demand is the sole cause is a convenient distraction. The sophisticated market players seize the Supreme Court threat and the inevitable $200 billion hole. They recognize that the Treasury's options are limited to either massive new debt issuance or aggressive inflation. Both outcomes necessitate a flight into assets that cannot be manipulated by central bank policy. The sustained premium in Shanghai is not market friction, but rather an accurate price discovery mechanism for physical metal free from Western paper risk. It indicates a global institutional preference for tangible ownership over derivative exposure. The divergence in pricing power is the strongest indicator that the global confidence in the dollar's role is severely strained. The speed of the silver move suggests that institutional actors are front-running the inevitable legal decision, knowing its catastrophic fiscal implications. The time horizon for this crisis is no longer years, but months, tied directly to the judicial calendar. This legal challenge provides a specific, traceable catalyst. Unlike generic economic slowdowns, The resulting debt issuance will compete directly with the existing massive debt refinancing needs of the U.S. government. This competition will only drive yields higher, further stressing the entire debt ecosystem. A sudden spike in the 10-year yield, particularly without a corresponding hike in the Fed funds rate, is the ultimate confirmation. It signifies the market, not the Fed, is setting the price of future debt based on risk assessment. Simultaneously, observe the behavior of the CME Group's margin requirements on silver futures. A sudden multi-session margin hike is the clearest internal signal that the exchange anticipates extreme volatility or potential delivery default. This move protects the clearinghouse but forces smaller, leveraged players out of the market, amplifying the physical squeeze. When both the bond market, yield disinversion, and the derivatives market, margin hikes, flash red, the systemic event is underway. The historical parallel here is the erosion of confidence during the 1970s, where the market eventually forced the end of the gold standard. We are now effectively in a fiat-on-fiat standard, where confidence is even more fragile and subject to sudden collapse. The silver market is simply the first, most sensitive canary in the coal mine, reacting violently to this fiscal vulnerability. Its low nominal price relative to gold makes it highly attractive for retail and institutional hedging simultaneously. The 88 price tag is a warning sign that the cost of government borrowing is about to skyrocket. Protection is not about optimizing returns. It is about preserving principal from the corrosive effect of policy errors. Diversify out of your native currency and into assets that have thousands of years of trust history. If you hold paper exposure to precious metals, use this opportunity to convert it into physical holdings. The difference between paper and physical will become a matter of survival, not just semantics, when the Supreme Court decision is finalized. The integrity of your portfolio depends entirely on its resistance to government-mandated shocks and inflationary monetization. This is a pivotal moment in financial history, driven by an almost unbelievable combination of legal risk and fiscal irresponsibility. The market is telling you exactly what it fears, that the United States Treasury is fiscally exposed to an unplanned $200 billion hole. The resulting capital flight is exactly why silver has broken historical norms and is establishing a new paradigm. Pay close attention to the Shanghai premium. It is the clearest sign of physical scarcity and distrust of Western derivatives. Undefined. Your focus must remain on preservation. The ultimate risk is no longer market volatility, but outright debasement of the dollar. The era of cheap debt and limitless government spending is reaching its painful, structurally mandated conclusion. Do not be caught holding the bag of depreciating paper assets when the legal decision forces the Treasury's hand. Physical silver, at this price, is not a luxury investment. It is essential portfolio ballast against systemic failure. Every investor must now view their holdings through the lens of sovereign risk. We are facing a moment where financial solvency is directly threatened by political and legal errors. Prepare for extreme outcomes. The $88 silver price confirms that extreme outcomes are now discounted probabilities. Secure your tangible wealth. Diversify away from fiat dependency. The storm is not coming. It is already here, evidenced by the price of metal. We will continue to track the legal developments and the critical market indicators. Stay disciplined, stay protected. This analysis is provided for informational purposes only and does not constitute financial advice. For deep dives on global market volatility and sovereign debt, this is core finance.